Hello, welcome to my channel. Today I'm talking to you on the topic asset versus liability. Now, I got the idea to do this particular segment because someone who I respect very much said something about it, and I thought that's a great topic to discuss on my channel. What is an asset? Now, an asset is, in simple terms, something held by you as the business owner, or even just as an individual just out there, but it is held and it can be used over years. So for future use, such as a vehicle, a property, piece of land, a piece of furniture, your computer, those are all assets. They're not expenses because they will last more than one financial year. They can be depreciated, they can be replaced, they suffer wear and tear, and in essence, in a nutshell, in a very simplistic form, that is the definition of an asset. Now, accounting standards will give you a long-winded definition which you won't understand. I've chosen to go the simple route and explain. The difference is, if you have an expense, this is a cost that you're incurring as a business, and you're charging to what we call our income and expenditure section, which is the same as the profit and loss section. So it's being spread out over the year, and it's being used to reduce your profit or your taxable income. So it appears against your turnover, your revenue, in order to arrive at what we call your bottom line, which is your profit. That is an expense. An asset is different because it appears on what we call the statement of financial position, which used to be called the balance sheet, and it is purchased for the sole purpose of being utilized in the business over long term. If you're in manufacturing, those can be your plants, your machines. If you're not in manufacturing, then maybe it's just your vehicle, as we mentioned, or your property. Those are assets. They are usually depreciated, and it's usually over their useful life. So that can be over 5 years, over 10 years, or sometimes even over 3 years, where you have like computers and printers. Those are seen to be assets that depreciate rapidly through rapid use. They must be replaced. Therefore, you'll find what we call the net book value depreciates, or it reduces rapidly. Now, when you depreciate these assets, there are two main ways that we're going to look at this, what we call the straight line method or the reducing balance method. The straight line method simply means that you are applying a percentage, for instance 20%, 10%, 33.3%, but it's all on the cost. So your depreciation will be the same every year. If you use the reducing balance method, that means your depreciation is levied on the net book value from the previous year. Therefore, it won't be the same amount every year. Your depreciation might be a fixed percentage, but you're depreciating against a different amount. You're not depreciating against that initial cost. So that is the difference between the two methods, the straight line method and the reducing balance method. The other thing I need to note, and this many people will be shaking their heads at me, when we talk about an asset, let's talk about the vehicle. You're buying it, for instance, you're buying a luxury vehicle, let's say it's costing you 1.8 million. As you drive off from the dealership, in real terms, your car has already started to depreciate. It's no longer valued, or you can no longer sell it at the same value that you purchased it for. You're starting to charge a mileage on your vehicle. It's already starting to suffer wear and tear. Therefore, in loose terms, what people in the textbooks would have called an asset, for you and I, in reality, it's not really an asset. It's not really going to last forever. It's already costing you, in a sense. So it's actually not a very good asset. because it's not going to appreciate in value, it's going to depreciate in value, and it's going to cost you. And this is why we provide for depreciation, because we're saying in a few years you may have to replace that car. Have you put aside enough to do that? Have you provided for it? Have you accounted for it? And this is why we don't reflect assets at their initial cost value over the years. That is, of course, except when you're just dealing with buildings and land. Now, these are seen to be assets that appreciate over time. They do not depreciate. They do not need to be depreciated unless if it's a building that's being used for some very rough work. Then you'd say, okay, well, the value of the building has actually depreciated, the value of the land. Now, if you're in farming, it's a slightly different concept, because you're using your farm, you're using your land to farm, and you're yielding fruits, you're yielding crops. So it's a slightly different accounting treatment. Join us as we discuss these and many other related topics on our channel. Enjoy. Hit the subscribe button and like our channel. Thank you.